Hi everyone, I'm Ali, and in this video we'll talk about the relationship between an auditor and other key groups. The key groups that the auditor will have a professional link with are the client shareholders as a group, the board of directors, the audit committee, and the internal audit team. In this slide, we will be looking at the relationship between auditors and shareholders. The audit report is addressed to the shareholder of the company being audited. This means that the auditor acknowledges shareholders as the main recipients of the financial report and the attached audit report. Shareholders rely on the audit report and opinion contained within it to inform them about the reliability of the information included in the financial report. Auditor does not often meet the shareholders their report to accept when they attend their company's annual general meeting. Shareholders are responsible for the appointment and removal of their company auditors. Nevertheless, the board of directors or the audit committee facilitates this process on behalf of the shareholders. Generally, the board of directors will select an audit firm that they believe is appropriate or will propose when it's time to appoint a new audit firm. The board will then make a recommendation to shareholders. Shareholders generally follow recommendations made by their board of directors. The board of directors oversee the activities of the company and its management on behalf of the shareholders. A board of directors will generally comprise a mixture of executive and non-executive directors. So what is the difference between the executives and non-executive directors? Executive directors are part of the company's management team. They are full-time employees of the company, whereas non-executive directors are not part of the company's management team. Their involvement is limited to preparing for and attending board meetings and, where relevant, board committee meetings. Boards of larger companies generally have several committees made up of various members of the board. Examples of board committee are such as the nomination committee, the audit committee, the remuneration, and the risk committee. The role of these committees is to effectively deal with specific important issues. It is a director's responsibility to ensure that the financial report is prepared to provide true and fair view. It is the responsibility of the external auditor to audit the financial report. The audit partner will meet with members of the board of directors when necessary throughout the audit. The main board committee that the audit deals with is the audit committee. An audit committee acts on behalf of the full board of directors to ensure that the financial report is true and fair, and that the external auditor has access to all records and other evidence required to form their opinion. While the ultimate responsibility for the truth and fairness of the financial report rests with the full board of directors, an audit committee can improve the efficiency of achieving this goal. The ASX requires that the top 500 listed companies must have audit committee, and the top 300 listed companies must follow the ASX Corporate Governance Council's recommendations regarding the composition, operation, and responsibility of an audit committee. An effective audit committee will enhance the independence of the external audit function. From an audit perspective, it is important that the audit committee be independent of the remainder of the board and of the financial reporting function. Ideally, the audit committee should consist of only non-executive directors, with a majority also being independent. Furthermore, an audit committee should consist of members who have financial accounting knowledge and who can read and understand the contents of the financial report. It is important that the audit committee members have some understanding of the accounting policies used by the company and can communicate easily with the auditor about those choices. The external auditor will report to the audit committee when they have had a significant disagreement with the management regarding accounting choices made. Even auditor will report to the audit committee when they are not happy with the contents of the notes to the financial report. When a company does not have an audit committee, the auditor will meet with members of the board. The external auditor views the internal audit function as part of the audited company, and as such, the internal audit function can never be wholly independent of the company. However, if a company has an effective internal audit function, the external auditor can consider reducing the extent of their own audit testing. If an external auditor intends to use the work of the internal audit function, they consider some internal audit characteristics such as the objectivity and the technical competence of the internal audit team, exercise of due professional care in the internal audit function, and communication with internal audit team. The objectivity refers to how the internal audit function fits within the client's organization and structure. It is really important that it establishes the level of independence from the rest of the organization. The more independent the internal audit function, the more the external audit can rely on it. Technical competence refers to the skill, training, and ability of the internal team. The external audit may consider the background and qualifications, the level and recency of the training undertaken, and the extent of experience of internal audit staff. Due professional care refers to the documentation, planning, and supervision of the internal audit function. The external auditor is interested in the level of planning undertaken by internal audit. They will also want to see evidence of the procedure undertaken by internal audit team in formulating their conclusion. The next is communication. Communication between external and internal auditor is achieved through the scheduling of regular meetings, the external auditor having access to internal audit documentations as needed, and the external auditor informing internal audit of any issues affecting their work that arise through the course of the external audit. It is really important that the internal audit and external auditors are free to communicate without interference from a client management and staff. And in the next video, we'll talk about client acceptance and continuous decisions. Thank you.